Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the challenges for investors is always, where do you come up with new ideas? Now, I did a video about that recently with John Quast, which I will link to above. You can click on that to view that video. And one of the things that we talked about is how our everyday purchases and lives has really been a great way to find new investment ideas over time. So one that popped up recently for me is On Holding, owns the On brand. This may be a company that you're more familiar with, but I think it's not really a household name. Wasn't something that I was familiar with, but it's one of those opportunities to take a step back and look at, is this the kind of stock or brand that you want to invest in long term, or is it not? And so I want to walk through some of the things that I looked at when I dug into the stock and what I think about it now, why it's moving towards the top of my watch list. My name's Travis William. Thanks for watching. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And let me just start with what the company is and what they do. On is really known for their running shoes, but they also have apparel and accessories. So really a running / fashion brand that I think would be analogous to something like a Lululemon in the running space. Just show a few of their products here. Their clouds. This is really what they're known for, especially in the running community. And you can see these price points, $170, $150. These are fairly expensive shoes. They're not the most expensive shoes on the market, but high up there and definitely not a budget kind of an item. If you look at the activities, you can see all kinds of different running, but everything is really running related or some sort of lifestyle product. So that's the way to think of this company. It's a little bit more niche than some of the other brands out there that are making running shoes. And they keep popping up more and more to me. Maybe that's because retail is more available where I live, but it's a reason to look into the brand a little bit more if it keeps popping up in your life. So what I did here is went to the company's investor relations page, ultimately their earnings report, and their first quarter 2023 earnings report, which came out in mid-May, shows a lot of really impressive results for the company. Growth rate of 78.3%. That's just astounding for any company, especially a brand company that's making something like shoes. Gross margin is 58.3%. That's incredibly high. If we go down here to the financial statements, you can see some of the details here. One of the challenges for a growing company is you're often spending a lot of money on selling, general, and administrative expenses. So building out the sales infrastructure, the product development infrastructure, the supply chain, lots of costs go into growing a business. And sometimes it takes a little while for that to actually reach the bottom line. But they are reporting net income. So that's another positive. So this is a very, very fast growing company and reporting net income. The other thing I want to take a look at is outlook. For the full year of 2023, management is expecting at least 1.74 billion francs. Did the conversion here, that's $1.9 billion worth of revenue expected for this year. That compares, as you can see here, to $1.48 billion in revenue over the last 12 months. So management is still expecting a ton of growth over at least the next 3 quarters. And it seems like momentum is only building for this company. So the numbers are great. Here's another chart that just shows some of the baseline information, revenue, net income. And then you can see here at the bottom, price to earnings ratio, 108. So this is one of the challenges with a high growth consumer goods company like this is, how do you think about the valuation of the company? I want to show a couple of comparisons, and I'm going to use Nike and Lululemon as my comparison companies. Nike is obviously the most established, but Lululemon I think is a good comparison because they have very high margins, has typically been a high growth company, and is in kind of a niche business a lot like On is. Price to earnings ratio, again, doesn't really tell us a lot because when companies are growing very quickly, they're not maximizing their earnings, they're maximizing their growth. Price to sales ratio is maybe a little bit more meaningful for these companies from a valuation perspective. You can see that On is trading for nearly 3 times the valuation of Nike. But again, this is a company that's growing 70, 80% per year. So if they do that for a couple of years, they're actually going to be cheaper on a price to sales ratio. So this is kind of the balance we have to play as investors. How long do you think that a company can grow? And here you can see the comparison of quarterly growth year over year. On is just growing much, much quicker than either Nike or Lululemon. So makes sense that they are a more expensive company. The question is really going to be, how long can we expect them to grow at this rate? This is a pretty quick overview of On, but again, this is a company I'm just putting on my watch list now. What I really like is the company's increasing brand awareness. It seems like they have a really quality niche for themselves. I have heard people talk nothing but positively about the brand and about their products. Very high price point and high margins as a result. I like that a company can grow profitably. The question is it a good value for investors? And I think this is where, if you take a very long-term view, I'm not actually scared about paying a high price like we have right now, because it's within reach of some of its bigger competitors. We're not talking about a stock that's trading for 30 or 40 times sales when competitors are trading for a tenth of that. They're only trading for 2 or 3 times higher than the much more mature company like Nike. So I think that's actually a reasonable valuation. Now, what I want to see going forward is that growth continue. If they can keep revenue growth above 50% for multiple years, that would be amazing. And then how much can they leverage the bottom line? That's going to be the next challenge, is actually not growing the operating costs quite as quickly as revenue is growing and try to grow the bottom line. If they can do both of those things, this could be a phenomenal investment long term. It's the kind of stock that I would like to buy and just hold for the next 10, 20 years and hope that this brand becomes something like Lululemon or Nike. And these kind of new brands in the fitness space don't pop up all that often. So that's why I think it's worth putting on your radar at least. And over the next few months, it may be the stock that I open a starter position in. But what do you think about On? I'd love to hear your comments in the comments section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.